All right, let's get started. So we've arrived at the very end, last panel of this conference. So yesterday's policy discussion was all about the practical and policy pitfalls associated with defense spending. And in this session, we're going to bring a slightly different perspective, thinking about the macro and fiscal impacts of spending from a different perspective. So we have two papers. The first paper is going to be presented by Jonathan, and João will be discussing it. And the second paper is going to be presented by Evie, and Ethan will be discussing it. So without further ado, Jonathan.
So thank you very much for the introduction and for having me here in general. I'm very excited to present this paper, The Price of War, which is joint work with André Meier, Gernot Müller, Müller, and Moritz Schularick. So let's start. What's the issue here? Well, the issue is that we live in a new era which is marked by heightened geopolitical tensions and outright wars breaking into the open. Yet our understanding of the macroeconomic consequences of wars is surprisingly limited. And against this background, we wrote this paper which responds to two questions. The first is, what is the macroeconomic impact of war? And there are two first-order channels that one may think about when thinking about wars. One is the military build-ups that are usually associated with wars, which have expansionary effects. And the second is death and destruction, which is also typically associated with wars and which is usually described to be contractionary. We reconcile these two channels by distinguishing in our analysis between different types of stakeholders to war. The belligerents, that is the countries that take part in each war, but also the war sites, which not only take part in war, but really those subset of belligerents that face material destruction and violence on their own territory. The second question we answer is, what about other countries? So here comes into play the third stakeholder, the third countries which do not take part in the war at all. And we show that these, in fact, also face substantial adverse economic spillovers from war. And to illustrate to you why this is such an important issue, we've brought this graph with us, which basically shows the frequency with which wars have been fought in the last 150 years. So the purple bars give you the number of war sites, again, those countries which really experience destruction on their own soil, and the red bars give you the neighbor countries of war sites, that is those countries sharing a common border with war sites. And what you can see is that the unconditional probability of being a war site in a given year is 6%, and the probability of being exposed geographically to a war site is 20% per year, suggesting that exposure to foreign war is rather the norm than the exception, as it occurs at a business cycle frequency. Our empirical analysis is based on new data for all interstate, intrastate, and extrastate wars since 1870. We conduct separate analysis for interstate wars, which are characterized by fighting between two or more recognized states, and other wars, which we use as a summarizing category for intrastate and extrastate wars. Think about civil wars and wars for independence. A new contribution of this data set is that we geolocate for all of these wars, the war sites. That is, we identify where fighting took place. And on top of that, for the interstate wars, we narratively identify the casus belli. That is the reason for which these wars have been started, which is key to our identification later on. Equipped with this data, we estimate the dynamic response to the average war. And we find that in war sites, GDP falls by up to 10%, and consumer prices rise by some 20%. As for the spillovers to third countries, we find that these crucially depend on the trade integration of those third countries vis-à-vis the war sites. So if we look at a third country that is not integrated at all, that is not importing any goods at all from the war sites, we see that output remains stable and prices only rise moderately. In turn, if we look at the counterfactual scenario of a third country which imports 3% or whose imports from war sites make up for 3% of its pre-war GDP, here we find that output falls by 2% and prices rise by some 3%. I won't be spending too much time talking about literature, just in the interest of time, jump straight into the data and the results. So how do we arrive at these results? We have new data. We have 3 different types of data sets. So we have macroeconomic outcomes for up to 60 countries starting in 1870, looking at output, inflation, capital stock, TFP, interest rates, equity returns, as well as military personnel and spending, which we source from fairly standard sources. And to identify the moderating effects of trade on third countries, we use data from the CEPI. At the very heart of our analysis, as I already alluded to in the introduction, is the data around war sites. And we identify these war sites in 2 steps, basically. So in the first step, we consult all the databases comprising data on wars and their participants that are out there. That is the Correlates of War Project and the UCDP, to identify all the wars and the countries that took part in these wars. And in the second step, we then geolocate the war sites. And we do this for interstate wars, which are typically, or which for parts are very complex, involving many countries having pretty geographically differentiated front lines. We do this by disaggregating these to the battle level. That is, we really identify all the battles that were fought in these wars, geolocate them, and then we collect for each of those battles the number of death, missing, or wounded people, which we dub casualties, and aggregate them back to the country level using today's borders. We then define the severity of these wars as the casualties incurred over the entire duration in the war relative to the local pre-war population. So this is the severity for the local country in which the war is fought. And for other wars, we basically do the same apart from the disaggregation to the battle level, simply because usually they're geographically contained in 1 or 2 countries, if you think, for example, about most civil wars. The resulting war sites are summarized in this table. So in panel A, you can see the interstate wars, in panel B, the other wars, and in panel C, the combined sample, which forms our baseline analysis and which comprises 694 different war sites. We have macro time series for 220 of these sites, for 319 belligerents, so parties to the war that do not face material destruction on their own soil. Again, think about, for example, the United States in the context of the world wars as compared to France. And we have data on 7,000 third countries. To give you an idea of how the severity of these wars is distributed, here's a chart that summarizes them. I'm not sure whether it's very well visible over there, but the y-axis basically shows the casualties relative to the local population, so the severity, and the x-axis shows the years in which the wars were fought. And so this biggest line here, so the interstate war with the highest severity was Slovenia in the context of World War I, which has faced a series of particularly bloody battles, particularly along the Isonzo front. Also, we see that the Falkland Island War was particularly severe, simply because if you think about how this measure is constructed, it's the casualties relative to the local population. If you have Argentina and the UK fighting on the Falkland Islands, which have a very, very small denominator here, then you will end up with a very severe war in terms of the local destruction. So now let me show you one last descriptive graph, already alluding to what we find in our more rigorous study later on. The graph is basically a bin scatter plot that relates on the x-axis the 5-year maximum drawdown in the follow-up of a war onset to the severity measure on the y-axis. And what we can see is that apparently the deterioration of output, so the output contraction, is pretty linearly dependent on the severity of the war within war sites. But now let's establish this in a more rigorous setting. And for this purpose, we introduce a set of local projections here. What we do is that we relate a set of macroeconomic outcome variables, such as output or inflation in logs, relative to the pre-conflict year over H years, to a set of controls. So these comprise country fixed effects, as well as 4 legs of the dependent variable and first differences, and as well of the regressors, and our war shock terms. So these war shock terms seek to capture the average effect that wars have on 3 different stakeholders: the war sites, S, the belligerents, B, and the third countries, T. So we estimate 3 different coefficients here, how countries respond to wars. So, and this coefficient psi here loads on the interaction of gamma and sites. Sites is in fact nothing else than our shock vector. It's a vector comprising all the countries that we have in our sample, and that only takes on non-zero values in the specific rows in which countries start to become a war site in a given year. And in this year, it takes on the value of the severity of the wars. So think about a scenario where country K is becoming a war site in year T, then the kth row of sites T would be equal to the severity of the war in K. Now, only equipped with the shock term, we couldn't do much, because only with the shock term we know where all the wars have been fought in the world. But we do not know how other countries or what kind of stakeholders other countries are in relation to these wars. And for this purpose, we have introduced this other vector, gamma here, which effectively maps into, so it's a vector of dummies that is mapping whether country I is a site, a belligerent, or a third country in relation to each war that is captured in sites. And in this way, we actually can estimate the average effect to foreign wars for the different stakeholders. But we are not quite done yet, because we now only have a coefficient loading on the average effect of war without accounting for the importance of the war site. So if we were only to estimate this one, then we would actually attribute a war with the severity of 3% of the local population in Liechtenstein to be the same as one in the United States or in China. And for this purpose, we introduced a second term here, where we effectively have a variable which is very similar to the gamma, but which is not anymore taking on the value of 0 and 1 in the case that a war breaks out, but it takes on a measure of weight, so to say. How important is the war site for the rest of the world? And in our baseline here, where we measure the average effect, this is simply the war site's population relative to the world population. And when we estimate the specification, we can then trace out the dynamic effects that wars of a certain severity and a certain importance of the war site have. So we have here the average size of the war site plotted, which is 3% population of the world population and 2% casualties relative to the local population. And what you can see is that we see a stark response of output and inflation in the war sites, with output lagging behind some 10%, almost behind the trend, and consumer prices rising by some 20%. Now, I also told you that we are not only looking at the average third country and belligerent. We also want to know how they respond depending on their trade integration vis-à-vis the war site. And for this purpose, we can simply redefine this mapper epsilon here to not capture the demographic weight of the war site anymore, but to capture now an economic weight, and in particular a bilateral economic weight. So now each value in epsilon will not denote the size of the sites anymore, but it will denote the bilateral, the imports of any country I from the war site relative to country I's pre-war GDP. And when we plot the response of output and inflation now again, we arrive at this picture. So the blue dashed line here gives you the scenario where the third country is not importing any goods at all from the war sites. And the red solid line gives you the scenario where the imports from the war sites correspond to 3% of the pre-war GDP of the third country. As you can see, output contracts starkly and prices increase as well for the exposed country, but not for the other one. The same holds for belligerents, albeit a bit stronger. When we look at the response of exports and imports themselves, again here the average responses across war sites, belligerents, and third countries, we see that in third countries and belligerents, in third countries and war sites, the exports as well as the imports seem to decline in the long run. And for belligerents, the exports decline as well, albeit they rise the exports rise for belligerents initially. Though what we find is that when we drop the world wars from our sample, this positive response for the belligerents ceases, which suggests, in our opinion, that these positive export effects in belligerents are mainly due to very complex global wars, which involve complex logistics among war sites and belligerents. This may also be responsible for the slight uptick that we see here for the imports in war sites. For third countries, we also see the same pattern, that those which are exposed via trade linkages to the war site see lower exports and imports. By the way, these are always in percentage points of pre-war GDP. We also looked at a series of other outcomes. So for example, at the capital stock and TFP, where again, the pattern emerges that the war sites appear to be worse off, which seems quite natural. We also looked at the long-term interest rate as well as at equity return indices and at military spending and military personnel. Interesting here is that this is the only response figure where we really see the same response of war sites and belligerents, which makes sense from the perspective that the belligerents also engage in fighting probably to an equal proportion as the war sites do. As for the robustness, we looked at several things here. So we excluded the world wars jointly and separately. We employed alternative severity measures, restricted the sample to shorter and longer wars, and a lot of other things. Some further evidence that we found interesting was that we found that wars also lead to a deterioration of democratic institutions, particularly in the war sites. So we see a decline of judicial independence, media freedom, and institutions in general. We looked at winners and losers, and it appears that in interstate wars, everyone loses economically, but it appears that the losers to war lose more than the winners. So that summarizes pretty well that response. And we looked also at neighbors at war and how they react on top of trade linkages. And the idea here is that the neighbors to war, they are facing a non-trivial risk of the conflict expanding and therefore also perhaps deteriorating investment and equity returns, which is what we find. Let me spend the last few minutes talking a bit about causality, because at least for the other wars, causality is hard to establish, I would say, especially when we look, for example, at recent episodes in Haiti, which were also like for parts triggered by rising oil prices and so on. We all have perhaps some anecdotes in mind with regard to how war itself has been influenced or may have been influenced by short-run economic considerations. For interstate wars, this looks a bit different. So we do not see any anticipation effects, neither in growth nor in inflation, preceding interstate wars. This is consistent with typical assumptions in the fiscal policy literature, where military spending tends to be used as an instrument for fiscal spending, but there's also some countervailing evidence. So for example, there are some studies that have shown that apparently the US is more likely to go to war provided they are in a recession and the president is up for re-election. So what do we do to reconcile these conflicting views in the literature? We conduct a narrative analysis in the spirit of Roma and Romer, where we classify the casus belli for all the interstate wars in our sample. So we are now moving in the subset of wars that are only interstate wars between multiple states. And for all of them, we want to find out, were they motivated by short-run economic considerations? And we come up with 8 non-exclusive categories for which wars have been started. The most common one being nationalism, with 57 wars in our sample, followed by power transitions and security dilemmas. We, however, also found 6 wars for which we at least could not exclude short-run economic considerations playing a significant role in their outbreak. One of them being particularly the Falkland War, another one being the Italo-Turkish War, which was preceded by a severe mass emigration and is by some sources also attributed to short-run diversionary domestic politic motives to divert the public from the ongoing recession. When we re-estimate our sample on the subset of narratively identified interstate wars, we arrive at very similar conclusions as we did in our baseline. And I would like to emphasize that our baseline is not driven by the interstate wars. Even if we restrict the sample to the other wars, which are completely orthogonal to what we show here in the sample, we arrive at similar conclusions. The same holds for third countries, albeit we, of course, observe somewhat wider confidence bands because we just threw out 2/3 of our treatments. I would like to caution against one thing when approaching causality here. What we did now was to exclude that what we observed prior to the war is driving the war. And we tried our best to go into narrative sources to make sure they really were not started for these reasons. However, it's not perfectly observable that there really were no economic considerations at play. So for example, a country may also go to war because it anticipates a future economic development in its adversary. This is something we have not checked for. We think this is not at play here based on our reading, but we cannot 100% exclude the possibility of this playing a role here. But some piece of evidence that we have in this regard also in a follow-up project is, for example, that we look at equity returns, which are typically forward-looking and which also do not see a deterioration prior to the onsets of these wars. So, I'm concluding early, I think. What have we done? We have looked at the macroeconomic impact of war. We find large adverse effects in the war sites, and we find that trading partners on the war sites also pay a substantial price as well. As for the mechanism, we had a bit more on the mechanism in prior versions of the paper, which also included a fairly standard open economy model that was rationalizing these patterns. Here our findings were that there was a supply shock which dominates in the war side and which spills over to third countries via a shortage in intermediate inputs. For belligerents, we found that these effects may be partly offset also by the expansionary effects of military spending. And we think of these findings having particularly important insights or relevance in the context of monetary policy, because as you can also see from the figures, we are dealing here with very, very large, very persistent adverse supply shocks that are differentiated in a geographic or that are differentiated across different countries, which is a particular challenge for monetary unions. Thank you so much.
We now have João, who will discuss the paper. Thank you, Jonathan.
Thank you. Thank you so much. First of all, thanks for inviting me to discuss this very, very interesting paper. It was a pleasure to read, although, of course, the topic is far from pleasant. So one question that people have been trying to think about, at least since antiquity, is what is the cost of war? So if you go back to Thucydides and you talk about the Peloponnesian War, and one of the discussions that exists there is, what is the cost if one nation state or one city-state decides to go to war? And before you think that this is something that only exists in history, this was the motivation for US policy during the Cold War. So if you read Kissinger is obsessed with the concept of a rationalist war and with the cost of war. And to my mind, sort of the crucial object there is to understand exactly what is this economic cost. And this is one of the contributions that the paper does. And a lot of our understanding comes from World War II or wars in developed nations like United Kingdom or the US, both of which usually involve relatively speedy recoveries. So trying to understand exactly how this operates in a wider sample of countries may be important, and this is what the paper does. And so the paper starts by assembling an enormous data set, roughly 150 years, 60 countries, data on war sites, belligerent, trade links, the casus belli of war. I mean, it's an incredible amount of data work, and yet I'm just summarizing it in a bullet point. Okay, so let me just go through the empirical design again. Jonathan did a great job, but I think it's important just to fix ideas. Most of what the paper does is based off this estimation of a local projection. So on the left-hand side, you have data at the country year level, and you project it on a series of controls, fixed effects, etc. And then the first terms of interest are these ones, which are going to capture what I'm going to refer to as the direct effects of war. So what happens to a country that happens to be a war site, what happens to a country that is a belligerent, what happens to a third-party country. And then there's a third part, which can, in the initial estimation, is simply the importance of this war site. But in the second part, and I think perhaps most interestingly, is the effect of trade links. Meaning, what happens if my main trade partner or one of my big trade partners suddenly enters into a trade disruption? And if you read, say, medieval literature, one of the main things that concerned merchants in Venice or in Genoa was if there was a war in China, because that closes the trade route. And so basically, you can think about this as the Silk Road coefficients. They're just capturing the effects of disruptions along trade routes. Now, the authors are very, very careful not to jump and give this an immediate causal interpretation. But one of the advantages of being a discussant is that I can be way more optimistic about the paper than the author. So I will give this a causal interpretation in everything that I talk about, because in a sense, wars very rarely take place only because of economic conditions. There are many other factors at play. And here I'm sort of shamelessly plugging my own work with Effie Ben-Melek. Okay. So let's go through the results. First result, war leads to a depression in the real economy. So you have a very persistent drop in output with a slight recovery, and a drop in TFP also with a recovery. So output does not fully go back to the pre-war level because the decline in the stock of capital is persistent. There's also a jump in the CPI, but then it kind of stabilizes around year 6. Also a decrease in stock returns and an increase in interest rates. So this would be sort of the baseline result. War is not good. But if you sort of integrate all the effects on output, you can sort of come up with a measure of the actual economic cost of war. Second result, even if countries are not engaged in war, but happen to be exposed to these countries, so in blue we have countries that are not exposed, sort of the reddish series is countries that are exposed, you still have a depression in output, you still have a fall in capital stock, TFP increases, which is somewhat puzzling, and I'll return to this later, and there's also a decline in overall trade with exports and imports declining. Finally, if you compare winners and losers, in terms of output, both lose, although winners seem to lose by less. So part of this could be just an appropriation of surplus as a result of the war. When you look at the CPI, it seems like the effects are far more persistent when it comes to losers. Okay, so let me then start by thinking about exactly what's happening with these spillovers. So the paper documents these relatively large effects on countries that have trade links to war sites. The idea is that you have a significant trade link, you rely on these intermediate inputs, or you rely on this on a market for your own goods, so you lead to a larger drop in output. However, trade flows tend to be shaped by geography. That's sort of the whole concept of gravity equations. Language, distance, historical ties, all tend to drive bilateral trade. These also may affect independent spillover. So if you're very close to a war site, you're also more likely to trade with it, and you're also more likely to suffer the effects of the war, even if you're neither a belligerent nor a war site yourself. Meaning that there is a need, at least in my mind, to try and separate spillovers from trade from pure spillovers that arise from geography. And fortunately, in the specification that the paper runs, there's a very easy way to do this, is simply to include the interaction of distance with all of these war sites. And then what you're going to pick up via the trade exposure is effects that are driven entirely by comparative advantage, rather than ones that may be driven by distance. Second, why does the capital stock decline? And this is kind of puzzling in the following sense. In most trade models that you can write, so if you think about an Eaton-Kortum type of model, you can always write output at the sector or country level as the product of TFP, this is sort of the usual total factor productivity. A term G that I'm calling gains from trade, this is just the ability of being able to source cheap inputs from abroad, and then just a production function. So one of the things that the paper documents is that TFP increases for countries that are sort of exposed to trade. So the marginal productivity of capital goes up, so I should want more capital. However, imports are going to decline, meaning that you're no longer able to source these cheap inputs. And so one of the things that's going to happen is that effective productivity is going to go down. And this in turn means that you want less capital. And it seems like in their results, this trade effect tends to dominate. So it's one example where the absence of gains from trade is really going to be driving a lot of these macro effects. Okay, I need to speed up. So now let me talk about the price level, and I'm going to try and do this without entering into discussions about the fiscal theory of the price level. So why does the CPI go up? In my view, it's because wars lead to high deficits. So when you have a war, you have an expansion of military spending, which either leads to an increase in government spending or a substitution of other government spending with military spending. So G will either go up or remain relatively stable. Second, war tends to lower economic activity, and so you're going to lower your tax revenue. If you're talking about countries that become war sites, literally tax collection becomes, let's call it, difficult. If you are involved in a civil war, it becomes impossible because you lose part of the control of the territory. Another result that here again, plugging my own work, is that real government debt also tends to decline after wars. So if you have all of these things, there's only one way to make the government budget constraint hold, and that's with an increase in the price level. So in this case, the increase in the CPI is driven entirely by the fiscal side of the war. And one of the additional consequences of this, and we also tend to observe this around wars, is that you have a massive nominal depreciation that most of the times is not followed by a real depreciation. So there seems to be sort of perfect pass-through in these things. And it also tends to be worse for losers, as they are unable to capture any surplus. Okay. And another issue is, Jonathan showed a table where we see that the mean and median wars are sort of either 2 or 3 years long. So most wars are not that long. And yet the effects are incredibly persistent. And the question is why? Or if you'd allow me, why are the effects so persistent when TFP tends to go back to the previous level after 5 years? And the answer is that capital drops. Now, the drop in capital that the paper documents from a quantitative standpoint is consistent with either pure capital destruction, so war destroys infrastructure, destroys factories, and so the capital stock drops, but is also consistent with simply a massive reduction in investment. Because if you think about a drop in the capital stock of about 2.5% or 3% over a period of 8 years, that's consistent with just normal depreciation and setting investment rates to very low. But, of course, as capital goes down, the marginal productivity of capital is going up. So, in fact, you would like to invest. Moreover, when the country is sort of collapsing, potential equity returns are very high, because that's just the way equity returns work. But what, in fact, they document is that there's a massive downturn in terms of equity returns. They never recover. You never see a pickup. So the recovery that we think about after World War II for Europe, you never see it in the data when you sort of systematize this across countries. And the question is why? To my mind, there's 3 mechanisms. The first one, simple one, financial frictions. How do you fund reconstruction? Well, if you want to rely on internal capital markets or even informal capital markets, particularly after a war, you need to be able to pledge collateral. If there is no capital to pledge, because all of capital has been destroyed, or a large part of it has been destroyed, you end up with a credit crunch. And in fact, when we look at the data, we see that wars tend to be followed by a credit crunch, at least as far as domestic credit is concerned. Second, if you are borrowing from abroad to account for the fact that domestic capital is scarce, and you observe a large nominal depreciation, the actual cost of funds is going to be very, very high. meaning that the price of capital at home is going to be very, very high. And that is potentially one of the reasons why capital remains very low and why a recovery never takes place. Finally, if the trade links are broken, or if the trade links are sort of unavailable, and a lot of these countries are actually importing their capital goods, then the fact that trade is more expensive also makes capital more expensive, which in turn slows down reconstruction. So all of these things suggest that most of the recovery after a war is hampered by the fact that the country can neither finance its own reconstruction with internal funds, or external funds that are available are usually very expensive. And that's what drives this very long persistence many years after the war has ended. Finally, I wanted to end with what I call the good news. TFP tends to recover quite fast. And this is a good thing, because at least there's one part of the consequences of war that is not incredibly persistent. So again, if you think about a simple decomposition of output, assuming a Cobb-Douglas production function, 8 years after the war, output is roughly 5% below. This is for sort of the countries engaged in war. TFP has gone back to level. Capital is 5% below. So what I take from this is that also labor has gone down by about 5%. Now, one thing you might have in mind is that, well, this is a simple decline in population. But one of the things that they show is that population only really declines by about 0.1%. A second effect could be that there simply is a crowding out of the private sector in the sense that military personnel is expanding. But that increase in military personnel then dies out. And so people in principle should return to the labor market. And so why is labor going down? Why is effective labor going down? To my mind, there are three potential reasons. The first one is a permanent decrease in labor force participation. This is unfortunately one of the many consequences of wars that lead people to simply become incapable of working. The second one is a brain drain, or a human capital decline. In the early days of the Russian invasion of Ukraine, there was a lot of movement of relatively rich and well-educated Russians through the Scandinavian countries. And this is something that we have observed in many, many wars, because people with high human capital are also those for which it's easier to escape the country in order to avoid conscription or participation in war. Finally, it could just be that war is not the right time for people to be concerned about making investments in future human capital. And so I leave this question sort of for future research, but in particular for Jonathan, to think about the consequences of war for human capital, because that's another way in which the consequences may be very persistent. And I see I have 23 seconds, so let me just conclude by saying that despite the fact that I have 12 slides, I actually had very little to say about the paper, because the paper is really very good. It's unfortunately, and will continue to be, a first-order question, and they kind of do everything. And I wanted to leave you with this last message, which is my interpretation of their result on spillovers, which is that if countries that are not engaged in war but are somewhat exposed to it also suffer the consequences, then it's also in their best interest to prevent wars elsewhere in the world from taking place. And this opens the door to questions about the role of trade networks in the prevention or escalation of conflict. Thank you.
So we can open up the floor for some questions. There was a question here, I think Rodrigo, and then a question by Anna first here. Rodrigo?
Thank you. Very interesting and very sobering at the same time. So two very specific things. One is to throw debt to GDP on the left to see the cost of this. We have a relatively good data set at the fund on historical, so probably can be used very easily. The second one, let me go back to the issue of labor. I understood that the base case is 3% intensity, so that means that 3% of the population dies in the conflict. Is that correct? Assuming that's correct, in terms of working age, probably is like, I don't know, close to 5 to 10. So quite a bit of this may be just you don't have the bodies.
Okay, there's a question there.
Yeah, just briefly. Yeah, very interesting, but sobering indeed. Two short questions. The first is, did you also look into the years before the start of the war? So let's say countries that have been able to build up military capacity before the start of the war were more able to buffer the shocks than during the time of the war? And second, did you also control for external support? So countries that received larger external support were also able to buffer the shock a bit more. And then I also had the question on that, which I think would be really important.
Thanks. It's a question right back, and then Marius.
So thank you very much for the very good presentation and discussion. I was going to say that I enjoyed it, but I mean, so my question is the following. I mean, the data set is really amazing, and with 60 countries over a long time. So I was very kind of worried about the very long-term cost of war. So after 8 years, GDP is still not going back to the pre-war trend. So my question is, could we exploit a little bit the cross-country heterogeneity to see, you know, what conditions kind of accelerate the recovery after a war, whether this is fiscal space, external support, as Nadine said, or that, I don't know, capital is replaced with more technology advanced capital, or is it the countries that have less brain drain, as the discussant mentioned. So it would be really interesting from a policy point of view to understand what can we do to really accelerate recovery. Thanks.
I think Mario's here, and then I.
Very interesting. Two questions. The first, I'm trying to understand a bit the numbers. So the war side, GDP falls by 10%, and then for an adjacent third country, 2%, even if your exposure is just 3% in terms of imports. So that sounds to me like a very big spillover. I'm trying to understand why. It sounds too big, that's all I mean. The second, maybe related, is I suspect there must be a lot of heterogeneity in these effects, both in terms, you know, on war sides and in terms of the spillover effects. And, you know, you took a specific cut in terms of trying to see how this, this heterogeneity correlates with trade exposure, but getting more information about this heterogeneity would be interesting.
Thanks, great presentation, discussion, and also very sobering. So having been in charge of the IMF macro framework on the Ukraine program for 3 years, so many of the things are quite relevant. I have one broad question, which is the end of the war and how the war ends matters a lot in terms of GDP impact and actually other macro variables. Have you actually looked at how do wars end in terms of, you know, do you have peace, armistice, there are winners and losers, and this will certainly shape as well how the impact would play out. Thank you.
We have 2 more questions. We'll quickly squeeze in 2 more questions. I wanted to give everyone a chance to ask a question. So
thank you. Very quickly, triggered partly by the remarks by the discussant. My understanding of the results on inflation were that it was most due instead to, you know, the fact that when you move to a war economy, you lose production for regular goods, and so there is scarcity and there is an increase in the excess demand. Of course, I guess there's also some measurement error. I don't know how many resources are devoted to measuring prices during the war. And I was wondering whether you have information, maybe, I don't know, about say the price of specific goods that can give you information as to, you know, to discriminate between these hypotheses.
Okay, and one last question, I think, at the very back over there.
Thanks, very interesting stuff. Actually, one question already was asked by Resta, but I have another one. Did you try to look at the cost of war in terms of consumption? Because I think that there's quite a potentially a big difference between, you know, rebuilding versus scrapped capital, which, you know, and also like the assumptions about the scrapping rate that the war may induce. But I suppose the effects on consumption might be quite different than some of your effects on GDP. Just whether you thought about that. Yeah.
Quite a few questions. We still have some time.
So I'll just start right out with the last question, and I think it's an excellent point, and I think we all should bear in mind that output may be a very poor measure here of societal welfare. We did not really look at consumption simply because the long-run data during wars were not as reliable as we would have liked them to be. So now, to the first question, debt to GDP. We have looked in this, either in this project or in a follow-up project, but I have estimated this graph. It significantly rises, of course. I can't give you a total number on this now. But I can come back to you if you're very interested in it. Regarding the people that die, so the casualty measures that we have, this measure does not only involve the local population. So first of all, it's not only people dying, it's dead, missing, or wounded people, and it also contains prisoners of war. So 3% does not mean that 3% of the local population die. And because we infer this number from disaggregated battle casualties, for example, when we code France in the world wars as a war site, these casualties also comprise German casualties. So these are really all casualties that are incurred or inflicted on the soil of one specific sovereign country, and it serves as an approximation of the overall damage that is inflicted within this country. Years before the war, I think this is a super interesting question to look into. You may run into problems with identification, I would assume, but I think it's super interesting to think about how actions that countries have pursued prior to war modify the response that they have to it. We have not looked into this. I should say also at external support we have not looked into. Yeah, similar this question. Okay, regarding the big spillovers, yeah, I agree. We were surprised as well, but it is a very persistent feature in the data. And actually, we have a very early open economy model that we had to, or we have it. We had an advanced open economy model in there, which we threw out in the most recent draft, but which was actually rationalizing this. So if you're interested in how these large spillovers are constituted, I would suggest you to look into the early draft. I think it's the current CEPR discussion paper, but I can't reconstruct it right now. Also the heterogeneity was very, very prominent. Also, the end of war I found very interesting, but here again, it's very difficult to establish conclusive and causal findings here, simply because the ending of the war is most likely also driven by the performance of the economy during the war. So you would basically condition on the outcome of the economy to trace out how the economy does in the aftermath of the war's ending. And at least ad hoc, I don't know a very good approach to this. If you have, I'm very happy to write this paper. Yes, to the specific goods, as you already anticipated, the large horizon that we have here, historically speaking, prevents us from taking a more disaggregated view. But I would assume that looking into what goods are repriced and taking a more disaggregated view would be possible, provided that you look at the more recent period and also include, as we did in our baseline, intrastate and extrastate wars, because they were not as rare in the last 30 years as were the interstate wars in centralized economies. And I think
you're out of time.
Yes, I think so.
Unfortunately,
love.
So you could have a lot of good bilateral discussion. So our next paper is going to be by Evie, and Ethan will be discussing it.